Welcome back to the channel, guys. Today we're looking at a video and we're talking about the pros and cons of using leverage with liquidity pools. Again, you might be someone who's been providing liquidity across different protocols, across different dexes in the Ethereum or Solana ecosystem, and you might be wanting to take your liquidity pool game to the next level. I definitely think you should be well versed in the world of liquidity provision before you think about beginning to use leverage on your liquidity pools. But that's what today's video is for. We're going to look at some of the advantages and disadvantages of using leverage across different protocols, just like Revert and DeFi Tuna, what that means for you, and whether you should actually make a decision to do that based on your skill set, based on the risks at play, and whether you really want to make that move to the next level. So let's jump right in. Okay, so like I said, you may be used to providing liquidity across dexes like Uniswap, like Orca or Radium in the Solana ecosystem. Maybe you're even doing stuff on Base on Aerodrome or using yield aggregators and portfolio managers like VFAT. What we're going to talk about today are a couple of protocols like Revert Finance and DeFi Tuna that allow you to use leverage in order to increase your exposure in the world of liquidity provision so that ultimately you can generate more yield on your positions because you're able to increase the amount of capital exposure you have in the pool, but it does not come without its own risks. So again, Revert Finance is specific to the Ethereum ecosystem. You must be using the Arbitrum network in order to essentially enter pools on Uniswap that are native to Arbitrum. And you must be using V3 positions with these exact tokens below in order to be eligible to be able to add leverage on those specific positions. So again, you might be able to provide liquidity here to a WETH USDC pool on Arbitrum. There's a couple different fee tiers that are pretty lucrative here for providing liquidity and generating fees. So it does have to be pools containing both or one or both of these specific assets in the pool itself so that you can actually come on over here to Revert, enter the dashboard area, and then lever up the pool. You've actually got two options as to how you can do that with Revert. You can enter the pool initially directly on Uniswap if you wish to, and it will get picked up in your wallet in the dashboard area here once you come over to Revert, and then you can actually go ahead and begin to lever it up. Or you can enter the pool directly on Revert, creating your position. But just know that if you are creating a position here directly on Revert and you need to swap one asset into the other into the correct ratios, Revert does charge a 0.65% fee on every single one of those swaps. So it may be more cost effective to open the pool directly on Uniswap first before entering it on Revert and then coming over here just specifically to begin levering it up. What do we mean by leverage? Well, essentially, what we're talking about here is the ability for you to borrow capital against your LP as collateral and then increase the amount of capital in the pool to significantly increase the amount of fees that you're able to generate. So, for example, you could deploy $10,000 into a WETH USDC pool. The $10,000 that you enter into the pool will act as collateral here when using Revert, and you can borrow capital against that. Obviously, you need to be careful and use a relatively safe loan to value ratio, but you can lever it up, let's say borrowing another $4,000 against your 10K worth of collateral. That then allows you to increase the amount of capital in your pool to 14,000 instead of just 10,000. And you can essentially increase the amount of fees that you're generating by 40% day over day, week over week, month over month. Okay, the same thing can be done here over on DeFi Tuna. If you're not familiar with DeFi Tuna, you might be familiar with other dexes native to the Solana ecosystem, just like Orca, just like Radium. What DeFi Tuna does is it actually allows you to enter and lever up pools on the Orca DEX. So it's integrated with Orca. And again, you have to actually come over here to DeFi Tuna. It's a little bit different to Revert in order to open the pool and add the leverage. But you can see there's a wide selection of different pool opportunities here, both crypto to stablecoin and crypto to crypto pool options, where you can essentially create a pool selecting the asset. Let's say we wanted to put $10,000 into this specific pool. You can then actually increase the leverage accordingly. For example, we could use 2x leverage on this particular position. In DeFi Tuna, you then have to determine the borrow ratio, and you must borrow in one or both of the underlying assets in the pool. So again, if you're bullish on Solana, you may not want to be borrowing Solana. You may want to be borrowing USDC in order to actually mitigate the price of Solana moving to the upside. It's going to help you actually be more profitable. You can see the payoff curve on the chart here. But for all intents and purposes, what you're able to do here on DeFi Tuna is quite similar to what can be done on Revert. You're using the collateral you put into the pool initially, this $10,000, as collateral to borrow against, and using 2x leverage. That would mean obviously I'm able to borrow another $10,000. Levering the pool up 2x gives me $20,000 worth of exposure in this Sol USDC pool, effectively doubling the amount of cash flow and yield that I'm able to generate on a daily, weekly, and monthly basis. So I hope you understand the basic premise of what's happening here with these different protocols. But let's talk about the pros and cons of using leverage like this, because again, I think, in my opinion, you need to be a seasoned liquidity provider before really starting to play with any type of leverage. There are risks involved here, and obviously there is the potential for liquidation when you're borrowing and you managing your health factor. So you need to be careful. Let's talk about the advantages and disadvantages. So advantage number one, again, amplified yield potential. It's a kind of obvious one here, but obviously if you look over here and we're using 2x leverage, instead of having just $10,000 worth of exposure in the pool, you're getting $20,000 worth of exposure, thereby amplifying your yield potential, essentially almost doing 2x the amount of yield if you're using 2x leverage. But there are some fees that you have to account for in terms of interest and very small protocol fees when you're using the likes of DeFi Tuna and Revert. Okay, but amplified yield potential is the most obvious and the biggest advantage, in my opinion, when using leverage. You're actually being able to increase that yield potential. And going hand in hand with that is obviously your entire position is much more capital efficient. Of course, if you have only $10,000 worth of exposure, you're limited in the amount of fees and yield you can generate. More capital efficiency is acquired from using this leverage. Yes, you're having to borrow it. Yes, you're having to manage those liquidation thresholds, but you are being more capital efficient with your own money using the protocol in order to borrow. You're paying a nice fee for doing that, which we'll look at in a moment, but you're using your capital much more efficiently in order to generate and amplify that yield potential. The final benefit is enhanced liquidity and mining rewards. Again, farming more incentives with boosted position sizes. Depending on the protocol you're using, there may be incentives and the ability for you to earn points. For example, DeFi Tuna are actually doing a token generation event in July of 2025. If you've been using DeFi Tuna, you qualify for an airdrop for DeFi Tuna, and you're going to be getting airdropped a whole bunch of their new DeFi Tuna tokens. And so obviously, the more capital that you're using, and if it's levered up on the protocol, you're going to have the ability to be eligible for more points and boosted rewards. Okay, so they're the main advantages. Of course, more capital efficiency and amplified yield potential are the two most obvious claims, but there are inherent disadvantages here. So let's make sure we understand those as well. Okay, in terms of disadvantages, amplified losses and liquidation risk. So yes, amplified yield is an amazing advantage of being able to use leverage across these protocols, but that also means you have amplified loss potential on the downside. If the price action begins to move against you and the price of Solana goes out of your range and begins to approach your liquidation threshold, you can see here that with this range, 147 to 156, using 2x leverage, the liquidation price when borrowing 100% Solana is down at $90. Now, I don't think we're going to jump down to $90 very, very quickly, but you would need to monitor that in terms of the inherent risks involved here, because if price does sharply drop from 152 all the way down to 100 and starts approaching this level, you need to get out of that position. You need to make sure you don't get liquidated, because the protocol is entitled to take your money, which is being used as collateral for all of that borrowed capital. Okay, liquidation risk, obviously very important to understand. Higher exposure to impermanent loss. Once again, divergence loss and price divergence leads to larger losses due to the leverage that is being used. Again, you can amplify those losses, and if that begins to work against you for a long period of time, and you're also not earning fees from being out of range, those amplified losses can really begin to increase. And if you end up closing the position before getting back into range, you have to lock in those losses, suck up that loss, and move on to the next opportunity. So you need to understand the potential for amplified losses on the downside and higher exposure to impermanent loss. And finally, the third disadvantage is the borrowing costs and the complexity. So there's interest costs and the risk of mismanaging a more complex position. This is why I definitely recommend you have a very good understanding of basic fundamental V3 concentrated liquidity provision before you begin to use leverage. First of all, like I mentioned, there is borrowing cost for using Revert and DeFi Tuna. Revert, like I mentioned, there's also 0.65% fees for any swaps that you're making to swap asset ratios between one asset and another. Over on DeFi Tuna, if you're borrowing the likes of Solana and USDC, you can also see that there is some borrowing costs that you have to pay. Again, you're generally paying somewhere in the region of 15 to 20% for borrowing USDC over here on DeFi Tuna. So you have to remember it is typically a much higher borrow rate. And what that means is you have to factor that into your equation for being able to generate additional yield, because there is those costs that will begin to add up over time. And of course, the complexity of managing these positions, especially with crypto to crypto pairs, where you have to think about the asset ratios and you have to think about the payoff curve, depending on what ratio you're borrowing. If you go into, for example, a CBB BTC Solana pool and you have to borrow a certain ratio of both CBBTC and Solana, you need to understand the relationship between the ratio of the assets in the pool and the payoff curve and what that looks like, depending on how long you stay in range and what happens if you begin to approach the wings and move out of either end. So there's more complexity involved here when using leverage, other factors to think about. So I wanted to run through all of those advantages and disadvantages. Again, if you're looking to step up your game here in the DeFi space, leverage is a very, very good way to do that. But you need to understand the risks. You need to have some experience under your belt. And if you're looking for assistance in that journey, check out the link below this video for the UIG. We're helping tons of clients across Fast Track and the programs that we run to consistently generate fantastic yield across using different protocols like Revert, like DeFi Tuna. Check out the link in the description below. If you're ready to level up, that link is for you. Book a consultation. We will talk to you. And that's it for today's video, guys. Make sure to drop a thumbs up below, hit that subscribe button, and we'll catch you in the next one.